Hi, I'm Rick Schwartz, one of the two partners at Schwartz & Schwartz PC. I want to thank you for signing up and attending today's webinar that's being presented upon year-end tax planning for individuals. Today, I'm going to address some year-end planning considerations for individuals. Primarily, I'm going to try to focus on the following topics: charitable planning, retirement planning, and updates due to COVID and the Secure Act that passed the end of 2019, Roth IRA and 403B considerations, managing capital gains and losses, tax credits with regard to electric vehicles and solar panels, which are here now. They may be going away in the next couple of years. So we'll talk about that in how to maximize that credit, maximizing benefits for self-employed individuals, planning considerations going into 2021. And I want to finish up with a couple of topics that come up a lot here: how to limit your risk of receiving an IRS tax discrepancy notice, and also things to be aware of that will limit your risk to an IRS audit, which seems to be a major concern, but hopefully you'll never have to go through it. So if you do miss any portions of the webinar today or want to revisit today's talk, I believe it's going to be posted on our website at schwartzaccountants.com. Additionally, if you want to have a follow-up conversation or have further questions, or if you have further questions on anything presented today, please call me if you'd like, or call your tax preparer in our office. Number, obviously, for those of you who've been here a while, 781-938-0045, and we can help you out with your thoughts and questions. So let's get started, and I'm going to lead off today talking about charitable deductions and what you may want to think about to maximize that deduction for you. Okay, so first, what I'd like to do is walk through a scenario where you're not giving a cash donation, but you're going to be donating appreciated stock or an appreciated mutual fund. So when you donate appreciated securities, you're actually allowed to take a deduction at the fair market value of the investment at the date of the charitable gift. Okay, so the date you give it to the charity, you can take a deduction of whatever that investment is worth. It only applies to long-term appreciated investments, not short-term. And the benefit is, if you were to go out and sell the stock and then donate the cash, you actually, by donating the stock or mutual fund, you avoid federal and state income taxes as well as net investment income tax. So I'm going to walk through a scenario just to show you exactly how this works and what the benefit is to you of making this type of a charitable donation. And I do want to say, with regards to the tax rule changes from a couple of years ago, the charitable donations is where you have the most, where you have one of the largest control over your taxes, because it is a deduction that is, for the most part, unlimited on your tax return. I am going to talk about that a little bit further down the road, but you have a lot of leeway on donations that impact your bottom line for taxable income. All right, so if we look at a scenario with regards to a cash donation from the sale of a stock, let's look at some specific numbers. Say you have a stock that you purchased several years ago. You paid $2,000 for the stock at the time of purchase. Today it's worth $12,000. You go out on the market. Long-term capital gain is going to be $10,000 when you sell this stock, right? You got 35% marginal tax bracket, but then you have a federal income tax rate on long-term capital gains that's 15%, which results in a $1,500 tax. Net investment income tax on your federal return is 3.8%, so there's another $380 tax. And then mass income taxes are 5%. So total taxes paid with regard to this sale of stock is $2,380. Okay, the other option is, or actually continuing on, so after you deduct out the taxes from the total proceeds of 12 grand, you're left with $9,620 that's available to contribute to the charity. right? So tax benefit at a 35% tax rate leaves you a tax benefit of $3,367. Taxes due from the sale of the stock is $2,380. So the net tax benefit in this situation is really $987. You paid taxes, but you got a tax benefit from the cash donation, and overall you're up. So it seems like a good idea, right? Well, if you have stock to donate, looking at it from the second scenario, again, same stock, purchased for $2,000, current fair market value of $12,000, same parameters, except for in this situation, you're not selling the stock, so there's no taxes, federal, state, net investment, income tax, all zero. You donate the fair market value of the stock, which is $12,000 that you're allowed as a deduction in your tax return, same 35% tax bracket. So tax benefit in this situation is $4,200. So quite a big difference compared to selling the stock, paying the taxes, donating what's left, and the resulting tax benefit is $987. So if you are holding investments in a after-tax account, and you are looking to make a sizable charitable donation to your school, maybe there's a foundation at work, your religious institutions, so you want to consider donating the appreciated value of stock, and you're going to end up ahead. And then you could, if you like the stock, say it's Apple stock that went up a lot in value over the past 10 years, you can actually go out and buy the stock back again for what you would have donated in cash. And now you've stepped up the basis of this stock, and then when you sell it down the road, your capital gains will actually be a smaller number because you're now tied into that stepped up basis of the stock. Here we go. So here's the, like I said, so the tax benefit comparing the two is a $4,200 benefit versus a $987 benefit in the second scenario. One thing that came about prominently over the past couple of years when the tax rules changed was people investing in donor-advised funds. So a donor-advised fund is a charitable giving vehicle administered by a public charity created to manage charitable donations on behalf of organizations, families, or individuals. To participate in a donor-advised fund, a donating individual or organization opens an account in the fund and deposits cash, securities, or other financial instruments. They surrender the ownership of the investment that they put into the fund, but they retain advisory privileges over how their account is invested and how it distributes money. Again, this became more common with the Tax Cut and Job Act of 2018 because of the limitation of the state and local income taxes, and they doubled the size of the standard deduction. So many more people that normally itemize their returns in the past took the standard deduction. This is one way to work around that new standard deduction. Okay, so essentially the way these work is you're going to front load several years of donations in 1 year. Okay, so you make that donation into the donor advised fund and you get that deduction in the year you make the contribution. Then over the next several years, you distribute funds out of the donor advised funds to various charities. So you're bunching up several years of donations into 1 year. And again, you get that deduction in the year that you fund the donor advised fund, not the years that it comes out to fund the charities. Let's look at an example of how this works and what the benefit is to someone that may not be typically itemizing their tax return. So in this example, there is a married couple, their wages are approximately 400 grand, income from investments is about $15,000. Their state and local income tax deduction is $35,000. However, it's capped at $10,000, the maximum allowed under the new tax rule. They don't have a mortgage on their house, and their charity is $13,500. So let's start off. They do not fund a donor advised fund, but they're making contributions of $13,500 to charitable organizations each year in 2018, 19, and 20. In each of these years, your standard deduction is $24,000. It's actually gone up since 2018, but for purposes of this illustration, let's consider it $24,000 a year for the 3 years, okay? So looking at this example, if you look at their itemized deductions, each year it's $23,500. You have $10,000 for state and local income tax, and your charitable donation is $13,500. Because your total itemized is less than the standard of $24,000, that is going to be your deductible number each year, the standard deduction of $24,000. So you are not getting any tax benefit from your charitable contributions. There is a benevolent purpose in donating, but the tax benefit is non-existent in this scenario. Let's look at it now that you put 3 years of giving into a donor advised fund, and you do this in the first year in 2018, okay? So in this scenario, you are front loading your charitable donations of 3 years into 1 year. You're taking a deduction for charity in year number 1, 2018 of $40,500. So itemized deductions for the 3 years are going to be as follows. Year 1, you actually get a $50,500 itemized deduction because you're getting that charitable contribution up front in year 2018. 19 and 20, you're not making contributions into your donor advised fund or to charity. So you're going to do the standard deduction in years 2019 and 2020. So if you compare the 2 years, the total income tax in the year you fund the donor advised fund is $249,500. In the other example, your tax over the 3 years, $258,000. So by donating into a donor advised fund, there's actually a tax benefit of $8,500 in this scenario. So again, this is going to work best for people that maybe don't have a mortgage, so they would be doing the standard deduction, not itemizing their deductions. It's a way of getting a large charitable deduction in one of the years out of a 2, 3, 4, 5-year period of time, however you're going to work it. And then over that next 4 or 5-year period of time, your donations will come out of the donor advised fund to the various charitable organizations. So you're still donating to the same places, same amounts. You're just taking the large deduction in year 1. And going back to what we just talked about, with regards to donating appreciated securities, you can actually donate long-term appreciated securities to the donor advised fund and take that stepped up value as your deduction and avoid income taxes if you were to sell stock and then fund the donor advised fund with the remaining cash. So something to consider. This comes up in conversations with clients all the time. They weren't aware of these, and they really didn't come into popularity until about 2 or 3 years ago when the tax rules changed. Okay, gonna shift gears a little bit and talk about still charity, but with regards to taking distributions out of your retirement plan. And I'm gonna start with talking about qualified charitable distributions. So if you're over age 72 and you withdraw from your IRA, you can have the funds go directly to a charitable organization, okay? And there's a $100,000 limit on this per individual per year. The qualified charitable distribution, QCD, it actually satisfies your annual required minimum distribution if you are age 70 and a half, the old rules, now age 72, and need to take that distribution each year. And you may not have a mortgage, you may not itemize otherwise. This will allow you to report less income on your tax return by funding the money directly into the charitable organization. So something to consider if you are taking required minimum distributions and you typically aren't going to itemize your tax return. Beginning in 2020, they have a new charitable deduction of an allowed $300 deduction on your tax return if you use the standard deduction. So be aware, it's new this year. If you're meeting with your tax preparer and you typically do the standard deduction, so you don't worry about what your charitable donations are, well, this year you want to keep track of them because you will get the deduction of $300 on your tax return this year. So regardless of filing status, that's the number. It has to be a cash donation. Donations in kind to Goodwill, Salvation Army, auto donations don't qualify, and it must be given to a 503c public charity. They don't want the funds going into donor advised funds that will not qualify. So just be aware of this year. It's new, and I think it's part of the whole COVID-19 crisis where they're trying to get funds into charitable organizations. Another change this year, 2020, and again, this is COVID related. With the Tax Cut and Job Act, you were only allowed to give 60% or take a deduction of up to 60% of your adjusted gross income as a charitable contribution. So if your income was $100,000 and you could afford, obviously, a large charitable contribution, you'd only be allowed to take a contribution deduction up to $60,000, 60% of your adjusted gross income. All right. This rule went away in 2020 once COVID came. Again, government was trying to enable people to make large charitable contributions where it was needed. And again, similar to the other the $300 that we just spoke about, donations to donor advised funds do not apply. And it only applies to cash contributions that you make in 2020. With regards to the Secure Act, that this is passed legislation end of 2019. They changed the rules with required minimum distributions. So now you don't need to take one until you're age 72 or older. It used to be 70 and a half. The issue that impacts our client base a little bit more are the stretching rules with regard to annual required minimum distributions. Okay, typically, if you're a beneficiary of a retirement plan as a death benefit, you were required to take minimum distributions each year. With regards to the new rule, you don't have to take them each year. You can take as much or as little as you desire to take. The only caveat of this whole thing, everything must be withdrawn from the inherited IRA in year 10. So it's got to be fully liquidated by the 10th year after inheriting these funds. Okay, another item that came into place with regard to COVID is that anyone receiving required minimum distributions did not need to take them in 2020. So even if you had taken a distribution earlier in the year, you could fund it back into an IRA by August 31st. So if you missed the date, you can't go back in time, unfortunately. But if you haven't taken the full amount as of December 31st, you can hold off on taking it. You don't need to take the remaining amount at this point. You may want to kind of give some thought to where the taxes are going to go, tax rates with the new administration coming in another couple months. But you have the option of not taking your required minimum distribution over the last couple months of the year if you decide not to. Additionally, with regard to COVID-19, if you were impacted financially by COVID-19, then you could take a $100,000 distribution out of your retirement plan this year. Okay, so you could designate $100,000 as a coronavirus-related distribution. You'd end up reporting it on your 2020 tax return, but you have the option of taking the taxes on those over years 2020, 21, and 22. Or you can elect to pay the taxes in full in 2020. So it's your decision. There is no 10% early withdrawal penalty on it if you're under age 59 and a half. And if you decide that you don't need the funds, you have as late as 2022 to repay the funds back into an IRA and not pay taxes on it at all. And if you had paid the taxes previously in 2020, 21, you actually can amend that tax return to not pay the taxes on those distributions as a CRD. Okay, so what qualifies as as a CRD? You're diagnosed by a test approved by the CDC, or your spouse is. You experience financial consequences as a result of being quarantined, furloughed, laid off, having reduced hours. You have reduced hours and unable to work because of lack of childcare. And finally, which is a bit gray, but I think it almost covers everyone, you experience adverse financial consequences as a result of closing or reducing your hours of a business that you own or operate. So business owners that had to close their doors for a month or 2 or 3 or longer, you will qualify for this distribution out of the coronavirus related distribution out of your retirement plan. So you do pay income taxes on it, but you are allowed to take this out penalty free and spread the tax hit over a 3-year period of time. One item that comes up periodically with my client meetings that not very many people know about are ABLE accounts. Okay, and these are accounts that were set up for individuals that have disability, specifically eligible individuals with disabilities that have been diagnosed before turning age 26. Okay, the beneficiary or the child or the young adult is the account owner. They are allowed to receive $15,000 annually from various people. Could be from your parents, the child's grandparents, friends of the family, but the max to be received each year is $15,000. There is a cap over the lifetime of these vehicles, ranging, depending on state rules, from $235,000 to $529,000. Massachusetts, that cap is $400,000. You can roll over funds from a 529 plan into the ABLE plan. It is funded with post-tax dollars, so you're not getting a tax benefit for funding these plans. However, as long as the funds, when distribution time comes, are used for qualified disability expenses, the funds come out tax-free and you don't pay taxes on the earnings of the fund. And there is a lot of qualifying expenses that will meet the rules: housing, food, maintaining independence, education, medical care expenses, personal care, assistance that is needed. So there's quite a wide variety of expenses that are allowed to come out tax-free related to these funds. I want to spend a little bit of time on Roth IRAs because I do think they're important for people if you can afford to do them and you don't qualify for making the IRA contribution or Roth IRA contribution because your income is too high each year. Again, it's another item that comes up regularly. One of the questions I get is, what do you think? Should I contribute to my 403B plan that's a Roth, or get a deductible 403B, or make a deductible 403B contribution via salary deferrals at work? So my question always is, can you afford to forego the tax savings of the salary deferral that is into a deductible 403 or 401k plan? And if you can, I think you should consider funding the Roth. You know, if you don't, and again, you're talking $20,000 of contributions. The tax savings on that could be as high as $6,000, $7,000, $8,000, $9,000, depending on what tax bracket you're in. So if you can forego that tax savings, I think you'd want to consider funding into a Roth at your employer's place of work if it's offered. The main benefit is tax-free earnings versus tax deferred. So when you're drawing out later on in life, it comes out tax-free, which I think most people know at this point. So again, it's foregoing tax savings today for the promise of all these funds coming out tax-free later on in life. You can still make a contribution to your 457B plan that's maybe tax deferred. So maybe split it up a little bit between the two plans. You still get some tax benefit. You may want to talk to your financial advisor where you're going to be in the future with expected tax brackets. It's a little bit of anyone's guess, but I think it's worth the conversation with your financial advisor to give you a little bit of guidance on this. And the portion you put in out of salary deferral into the Roth will come out tax-free, but the employer matching contribution is a tax-deferred contribution. So that will be taxable when that's pulled out as part of the required minimum distribution later on in life. And just another thing to be aware of, required minimum distributions for Roth IRA, for Roth 403B and 401k plans are required at age 72. It is not required if it's in a Roth IRA. So, and we're going to talk a little bit about that in a few minutes. All right, I want to continue to focus on Roth retirement plannings for a bit longer. Let's highlight a comparison of traditional non-deductible IRAs versus a Roth IRA. Okay, so Roth IRA, let's see, non-deductible IRA, it's a non-deductible item on your tax return when you do your taxes, as is a contribution to a Roth IRA. As we spoke of, it's similar with regards to the retirement plans at work. A non-deductible IRA is tax deferred, meaning taxes are paid on earnings when you have the required minimum distributions later on in life. Earnings come out tax-free with a Roth IRA. Okay, the biggie is required minimum distributions by age 72 for a non-deductible IRA. If it's in a Roth IRA, you are not required to take out a minimum distribution at retirement age or at age 72 or older. So an inherited IRA with regards to a traditional non-deductible IRA is taxable to the beneficiaries, whereas a Roth is not taxable to the beneficiaries. So Roth IRAs end up being an estate planning tool to pass wealth on to beneficiaries tax-free. So that's the one thing that I see with regards to these, because oftentimes you're not going to need that distribution, even though it would come out tax-free. But you're going to pass it on to your kids. All right, benefits of contributing to a non-deductible IRA annually. So tax-deferred growth, sure, that's probably a benefit. That's a good benefit. The fact that you have a required minimum distribution at age 72, I'm not convinced that's a benefit. It's a missed opportunity on long-term capital gain income preferential tax rate. So what I mean by that, if you were to fund into a non-deductible IRA every year, grows tax deferred. When you withdraw money at a later point in life, you're going to pay taxes at ordinary income tax rates on the earnings of that fund. So I guess the question arises, well, is it better to do that or just take this money, put it into some type of mutual fund that doesn't pay much in dividends each year, with the goal of being capital appreciation over a longer period of time. And then when you pull the money out or sell out of it and withdraw money from that, you're going to pay taxes on the earnings at long-term capital gains rate. So something to consider with regards to the non-deductible IRAs. And if it's in an IRA too, it's a bit tougher to get at the funds. You may have penalties on an earlier withdrawal, where if it's in an investment that's going to grow in value over time, you're just pulling out your own money. It never went into a retirement plan. There may be an issue with tracking basis if you commingle the funds. When you pull, maybe you pull the money out of a retirement plan at work that's pre-tax and you roll it over into an IRA, and then you have some non-deductible IRAs, you're going to be able to keep track of what is after tax contribution to what's before tax contribution. So it'll make it a bit tricky when you start withdrawing later on in life of what's taxable and what's not taxable. And you don't want to pay double taxes on anything that is went in after tax and then pay taxes on it again when you pull it out. So you really need to be careful tracking this stuff later on. And then the other item is, well, maybe it's a conduit enabling you to do a tax-free backdoor Roth conversion. So I think that's the biggest benefit of contributing to a non-deductible IRA, just the opportunity that would exist of making a Roth conversion at some point. So Roth conversions are tricky. It's a great strategy to fund a Roth IRA, but if you're going to do it, at least in the initial years, I'd work closely with your tax preparer just to make sure nothing's missed with regards to doing these, because the goal is to make it tax-free, which is a backdoor Roth conversion. To quickly go through the process, and again, I advise you to talk to whoever your tax preparer is before you start doing this. You need to review all of your IRAs. You want to determine what your fair market value is at the time you're going to convert. You need to know what your after-tax basis is in your IRAs, which is typically shown on Form 8606 of your tax return. Any appreciation, the fair market value in excess of that after-tax basis, you want to roll over into your company retirement plan. So it's gone from your IRA, and then you're just left with basis. So then you can convert that to your IRA, your Roth IRA, and it goes over tax-free. And then once you've essentially zeroed out that traditional IRA, every year you're going to make that contribution to an IRA, whether it be $6,000 or $7,000 if you're age 50 or older, and then immediately convert it to a Roth. So first you kind of got to clear out what's in your existing traditional IRAs, and then you have that opportunity to do the backdoor Roth. That's going to be a tax-free conversion each year. Okay, so you need to immediately convert it once you've gotten rid of all the excess fair market value in the IRA. Okay, managing capital gains and losses. I'm just going to go through this really quickly. I think most of the people have a pretty good idea of how this works. So capital losses offset capital gains. When you figure out your taxes on your tax return, you determine if it's a net gain or loss, which is your total capital gains less your total capital losses. If your losses are in excess of $3,000 in a year, which includes the current year losses or net amount, plus anything carried over from a prior year, and you're in excess of $3,000, you're allowed to claim up to $3,000 as a deductible item on your tax return. Any amount in excess of that $3,000 carries over into next year's tax return. Okay, so I think so you do want to review your portfolios, see what you have for unrealized losses and gains. Maybe it's a good time to sell out your losses, take the losses, and at the same time, maybe have some really strong stocks that have a large amount of unrealized gains in it. Sell them, offset them, and then what you can do, you actually can go back out and repurchase these investments that you liked and you want to maintain that may be appreciated a lot in fair market value, and you anticipate continuing to appreciate in fair market value, and now you've actually stepped up the basis. So when you sell it down the road, instead of having a basis of say $2,000 in XYZ stock, well, you've repurchased it now at the sale price, and say that was $7,000 or $8,000. So now your basis in that stock is $8,000 as opposed to $2,000. So it's one way of being able to wash your gains with your losses and take advantage of essentially deferring the gain into a later year. Okay, qualified opportunity zones. These are new a couple years ago. I don't have many clients that have invested in them, but I will go over them quickly. The opportunity is being able to defer capital gains on other investments. So qualified opportunity zone is, I'm just going to read this to you. According to the Internal Revenue Service, an opportunity zone is an economically distressed community where new investments under certain conditions may be eligible for preferential tax treatment. Localities qualify as opportunity zones if they have been nominated for that designation by the state and certified by the Secretary of the Treasury. Okay. So you can actually invest in these types of areas through qualified opportunity funds. Okay, so it is an investment vehicle, typically a partnership where you invest in the funds, and then the fund itself invests in economically depressed areas. So the major benefit of doing this is if you have a capital gain and it's significant, you can actually defer that gain by investing in this qualified opportunity fund within 180 days of the date of disposition of the original investment. And with COVID, they actually gave you a bit of a break because of the uncertainty with everything going on and funding and finances of people. So if that 180-day period in this past year fell between April 1st and December 31st of this year, you actually had until December 31st to make that decision to invest in a qualified opportunity fund. Okay, so the gain can be deferred until the earlier of December 31st, 2026. So when these were originally set up, I think it was an 8-year period that you could defer the gain. Or if you sell the actual qualifying opportunity fund itself, then that's the date that you have to recognize a gain on the underlying security that you deferred. And the gain recognizes the lesser of the deferred gain or the qualified opportunity fund fair market value less the stepped up basis. I'm going to talk about that in a minute. So when would you do this? I mean, I do have some clients that sell their practices, and with the intangible value of the practice, it's significant. So one, they may not want to pay the taxes on this now, so they'd invest into a qualified opportunity fund. You may have another investment that you can't recognize the loss now, but you know you're going to recognize that loss in a year or two. Maybe it's an investment in a building that's gone bad or some type of real estate. There may be some other type of investment in maybe a small closely held company that you put a significant amount of money into as an initial founder, or you know, they were just looking for funding. You're going to get no return and it ends up becoming worthless. So, but it hasn't happened yet, but you know it's going to happen within the next year or two. Well, that's in that situation, you'd want to fund into one of these qualified opportunity fund and defer the gain until that future date. So looking at a quick example, you sell ABC company for $100,000 capital gain, then you invest in the qualified opportunity fund. You actually get a step up in basis over a period of time. The 10% of the basis is a stepped up after a 5-year period of time. You get an additional $5,000. If it's been invested for 7 years, you would have had to make that investment by 2019 in order to get that additional 5% step up. So instead of having, when you sell it, in this example, a gain of $100,000, you'd only have an $85,000 gain. Okay, and then if you hold the stock beyond 2026, you'd actually have no gain on the additional cap gain recognized from the period of time that you had to recognize the gain to the value when you essentially sell it later on. These are tricky, so if you're going to get involved with them, I would definitely talk to your tax preparer first. One of the other issues you may face investing into these funds, they're not very liquid, I believe, similar to investing in a mutual fund or even stock. I don't think it's so easy to get your money out. But again, I don't have many people investing in these, so I don't know if that's you know, truly correct or not. You know, maybe it's not as tough as I've been told. Okay, I'm going to talk a little bit about tax credits. That there are a couple big ones out there that people are entitled to take, and that is the solar energy installation tax credit, plug-in electric vehicle tax credit, quickly tax credit versus deduction. A credit is a one-for-one reduction of your tax, whereas a deduction is a reduction of your taxable income before you take before you calculate the tax. So typically a tax credit will give you a larger benefit than a tax deduction on a tax return. The big one that's out there is solar tax credit for residential houses, okay? So if you put in solar into your house, you're allowed to take a credit, and that is a percentage of the cost of materials, labor, any other structural work done to get the panels in place. And there's no limitation. It's not affected by AMT. There's no phase out. So it ends up being a fairly significant credit. A lot of these solar panels, you're talking about costing in the range of anywhere from $20 to $40, $50,000. So the issue is now that this credit is going away. So the benefit of claiming the credit in 2019 was 30% of your installation costs qualified as a credit on your tax return. Well, that credit or percentage rate is gone. So anything in 2020 is 26% of your installation costs will qualify for the credit. 2021, 22% of the installation costs qualify for the credit. After 21, that credit is gone unless it gets extended. Massachusetts does allow a $1,000 tax credit as part of this as well. So again, and this is all done on your personal tax return. So just be aware with regards to when you can claim the credit. It is when the project is completed and placed in service. So if you're doing this in a home that you live in now, once it's completed, placed in service, usable by the owner, that's when you get to take the credit. So be careful if you're going to have this finished right near year end. You want to make sure this is up and going by December 31st, or else that credit is going to be reduced by 4%, where it would have been 26%. It's now going to be 22% if it's not done until 2021. If you're having a new house built, the credit is available and considered placed in purchase on the first day that you're actually physically living in that house. So just be aware of the timing of these things because they do change based upon the year it's put in service. The other big credit that I see a lot of on tax returns is the electric vehicle credit. So again, this is for a newly purchased car. If you are leasing the vehicle, you are not going to qualify for this credit. Once 200,000 vehicles have been sold, then the amount of the credit becomes phased out, and the credit is available in the year you actually drive the vehicle off the lot. Okay, so if you're pre-ordering, that's not when you get the credit. It is when you actually pass papers, sell it, buy it. The title transfers to you. That's when you qualify for this credit. Okay, again, once you hit 200,000 sales, or the manufacturer hits 200,000 sales, there's a limitation on the amount of the credit. So in the first quarter after the cap is reached, you still get that 100% of the credit allowed to be taken on your tax return. Sales for the second and third quarter after the cap is reached, you are only allowed 50% of the original credit. So a lot of these vehicles had a $7,500 tax credit. If you are in this period, you will only get a credit of $3,750, 50% of that original $7,500. And it's further reduced in the fourth and fifth quarters after the sales cap is hit, limiting the credit to 25% of the original tax credit. And then none is allowed after the fifth quarter is reached. So just make sure you're aware of if the vehicle has hit that $200,000 cap. I would assume the manufacturer could tell you where it is in that process. A couple of these credits are gone for some of the vehicles. Tesla is already phased out effective the end of last year, 2019. Excuse me. GM was phased out as of March 31st, 2020. So any of these vehicles that you purchase, you will not get the tax credit. So just be aware. And the link, and we can send this to you to view what cars qualify for the credit. Actually, we'll go on this really quickly. It's right off the IRS website, and it tells you what vehicles. So with the Audi, for instance, here's your credit available: 2020 Audi e-tron Sportback. Again, it lists them all out by the year and by credit available. Massachusetts has an additional program called the More EV program. You can do an application online for this credit. It went away, I believe, after the third quarter 2019. It came back reinstated at the beginning of 2020. You do this on your own. You don't do it on your tax return like the federal credit. There is a limitation. The car has to be less than $50,000 in value, and you do need to do the paperwork within 3 months of the purchase date of this electric vehicle. And again, here's the website at the bottom of this page. There is another tax credit with regards to electric vehicles. It is the EV, electric vehicle charging station. So it originally expired after 2008, 2017. I believe sometime in 2019 it was reinstated and went retroactive back to the 2018 tax year, and it's set to expire again after 2020. So it's you qualify for a credit which equals 30% of the costs of putting a charging station into your house, okay? And it's capped at $1,000 tax credit. If you move during the year, you put it in one house and then you put a second one in your new residence, you will qualify for as high as $2,000 tax credit. You'll get the tax credit at each location, okay? So, and if you did install this in your house and you didn't claim it on your 2018 or 2019 tax return or 2017, you actually can amend. You can let us know and we can do an amended tax return to pick this up for you. Okay, the next couple of pages I am going to skip due to time, and I'm going to, it's primarily with regards to self-employment and Schedule Cs. So most of our, I'm assuming most of the people listening are not self-employed, but you can certainly call me and we can talk about what we did skip with regards to this. Because I do want to move off to finish up with year-end planning considerations for the coming year 2021. All right, so one thing you should do at the end of the year, and maybe after you meet with your tax preparer, is figure out what you're having for withholdings from your pay. So if you sit with your tax preparer every year and you have significant tax owed every year, or even refund, you probably want to change what's being withheld on your W-4, especially if you're going to owe, because there are penalties and underpayment of tax that you may be subject to by owing a lot with your tax return at the end of the year. So you can make an adjustment. What I typically tell clients, if say they owe $20,000 and they've owed it pretty consistently the past couple of years, I usually say, you know, why don't you get your W-4 withholding certificate at work. Don't really change it, but there is a line 4C, have additional taxes withheld with each paycheck. So let's assume you're short $12,000 every year. You are subject to an underpayment tax. And you paid once a month, I would typically tell this client, you know, why don't you take the $12,000 you typically owe, spread it over the 12 months and have an extra $1,000 withheld per pay period. So that should hopefully remedy that issue. The other thing that I come across quite often are clients that get significant bonuses at the end of the year. And many of them are in a 35 or 37% tax bracket. And we're talking about a bonus anywhere from $50,000 to several $100,000. So what happens typically is they will withhold, your employer will withhold a flat 22% for federal taxes on this bonus. The problem becomes that most of these clients are in a 35 or 37% tax bracket. So say you make get paid out a $100,000 bonus, they're withholding at a flat 22%, which is all they're required to do per the IRS, but you're in a 37% tax bracket. So you're actually having $22,000 withheld, but being in a 37% tax bracket, the taxes owed on this $100,000 bonus is actually $37,000. So there's a $15,000 shortfall that you may see show up when you have your tax return done at the end of the year. So I usually try to tell my clients that know this is happening, look at their pay stub when it's paid out, and you can easily calculate the withholding percentage and maybe pay an estimate at that time to cover the shortfall while you have the cash in your pocket. Or two, talk to HR before the payment's coming, if you know it's coming, and let them know withhold at 35 or 37 or even 40% for federal taxes, just so you prevent this issue down the road. Okay, taking advantage of your benefit plans from work, dependent care benefit plan, $5,000. There is a health flexible spending plan at many places. Just be aware with regard to these first two items, it's use it or lose it. If you're not using this account that is an employer-sponsored plan, you're not going to get it back after the end of the year. So make sure it's funds you're going to spend. There is an employer health savings account if you're in a high deductible health plan, and you can contribute $3,600 or $7,200 if you're married to this pre-tax plan. And if you're over age 55 or older, there's an additional $1,000 you can contribute to the plan, and you can withdraw out of this plan to pay for medical deductions, okay? And if it's not used by age, I believe 65, you actually can withdraw out penalty free for non-medical expenses. Otherwise, if you're under that age and you pull out and it's non-medical related, it is a 20% penalty when you pull out. Cost seg, we are not going to talk about that. Following along the lines of planning, if you turn age 50, there is a catch-up contribution to your retirement plan of $6,500. You don't need to wait till the day you turn age 50. It's available in the year you turn 50. So take advantage of that if you can afford it while you're contributing to your 401k plan or 403b plan. Another thing to think about too, if you get large bonuses at the beginning of the year, you may want to fully fund your retirement plan at the beginning of the year if you can afford to do that. Again, why wait till do it sporadically or ratably throughout the year if you can put in that $19,500 or $26,000 if you're over age 50, put it in at the beginning of the year. The goal is that this is going to increase in value over your lifetime, so might as well fund it sooner than later. Perhaps pay estimated taxes to the IRS and to the state on a monthly basis instead of waiting till the quarterly or even at the end of the year. It just helps with budgeting. So you don't have to pay with the coupons. You can actually go online to this website and make a payment on your own. Another thing I see a lot of too is with regards to funding SEPs. Why wait until the tax return due date? Or I have clients that go on extension every year because they can't fund their SEPs. Try to do it ratably throughout the year if you can. Again, the sooner you get it in, your goal is that it's going to increase in value over time. So if you can afford to not wait till the tax filing date, don't. You can fund it during the year and have a conversation of what you'd be eligible to contribute with your tax preparer. We can give you an idea, and if you you probably want to underfund it and then top it off at the end of the year. But if you could fund 75% of this throughout the year, why wait? And then the problem becomes once you do that extension and you fund it on October 15th, you're in that habit every year with your finances. So I try to do it sooner than later if you can afford to do that. One thing you can do with Roth conversions, with the backdoor Roth conversions, is make 2 years of contributions at the same time, and then you do the conversion every year. So you can fund an IRA as late as April 15th. So what you may want to do is, let's say for 2021, you fund your 2020 IRA in the period of January through April. You fund your 2021 in the period January through April on the same date, and then you immediately convert it. So that way you can do 2 years of conversion every other year. It may make it easier for you than to remember, did I make the contribution? Is this year's? Is it last year? So it gives you a little bit more, makes it a little bit easier to do it over every other year as opposed to every year. And the last thing to consider, 529 plan funding for your kids, just make sure it's on the list of things that you do, okay? One thing I think people should do near the end of the year too is review what you have. For life-changing events, especially changing marital status, birth of a child, relationships with people that you know, death of someone in your family, you want to look at the beneficiaries just to make sure it's set up right. Make sure, God forbid, something happens to you, the money's going to go to the right place. So I'd review who those people are on the IRAs you have set up with regards to your employer retirement plans. Talk to your HR. They can help you see where this is set up. Life insurance policies and wills as well. So just make sure nothing gets missed over a period of time that you're going to regret at a later point in time. Okay, just a couple slides and we'll finish up. With regards to kids planning opportunities, so if your child earns $12,500 and they don't have any significant investment income, they're actually going to be exempt from state, actually from federal taxes. They may have a small amount of state taxes. So you can actually fill out your child's W-4 and write online 4C exempt, and that way no federal taxes will be withheld from their pay stub. They'll still withhold Social Security, Medicare taxes. The benefit is now you don't have to file a tax return to get back the federal withholding taxes. It just makes it easier at the end of the year. You don't have to pay someone to have your kid's tax return done. If you end up having to file a tax return because there are federal taxes back, even though they don't owe any taxes, I'd recommend going to the IRS free e-file, which is located on the bottom of this page. So you can go and you can easily fill in the information on the IRS website online. You can do the state at the same time and get the refund back to your for your child. Another thing to consider, if they have earned income, you can contribute to a Roth IRA. So it's a lesser of the earned income, or $6,000. The money doesn't even have to come from his or her bank account. You can gift your child and essentially fund the Roth yourself directly. So they still have the money from their summer job in their pocket. And one other item to consider is if your child is going to college and they do have some taxes, claiming the American Opportunity Tax Credit. So they are allowed to take that tax credit on their tax return. It is non-refundable for them, but it still can end up being a $1,500 tax savings if they have a $1,500 tax or higher on their tax return. Again, bring this up with your tax preparer. Make sure you give them a copy of the 1098-T that's received, and if they have W-2 income and have a tax, some of that tax can be refunded back to them that they're not going to need to pay. Finally, I just want to finish up some keys to minimizing IRS tax notices. So we have clients that get notices every year, not the same clients, but we do get a fair amount of clients that do receive notices. What to be aware of to try to avoid this: make sure you report all of your W-2s periodically. I do have a client that comes in that doesn't have one. They will get a letter from the IRS stating the discrepancy. Stock sales, don't miss out on reporting all of your broker statements. What happens sometimes is, say you have sales of stock on your 1099-B totaling $50,000, but you may actually have capital losses. Your basis may actually be $55,000, which will give you a $5,000 loss that you need to report on your tax return. Well, the IRS doesn't know the basis. They're going to issue you a letter telling you you owe taxes on $50,000. So it's a little bit scary to see the number on the IRS notice, but I do usually see a couple of these every year. So just be aware that you need to report this, all your 1099-B stock sales. If it's missed and you do get this letter, we actually will write an explanation, say, hey, look, if they had reported the sales, this is a cost basis, the tax is only this, or in several instances a year, I usually see that the taxpayer actually ends up getting a refund, even though there's a balance due with the IRS notice. Keep accurate records of your 1099 miscellaneous income. This happens often where a client will hand me all their 1099 miscellaneouses. For some reason or another, they don't report one, don't give me one, it never reached them, it went to their office. You will get a letter from the IRS if you're reporting less than the total 1099 miscellaneous received. Another issue, 1099-Qs, which are distributions out of your child's education account used for qualified tuition expenses. Roth conversions on a 1099-R. Form 1099-SA, health savings account distributions that are used for medical expenses. A lot of these items, you actually have to go online and get them. They're not necessarily mailed out to you. It depends on how you set up your account with Fidelity or Vanguard or where this stuff is. So just be aware that you need to go find these things sometimes, because if you're not reporting them, you're going to get a letter from the IRS assessing taxes, and we can typically resolve it, but you'd rather not have to deal with it in the first place. Another issue too, sale of your house. Some of the lawyers issue 1099-Ss, some don't, and if they report it, they're usually giving you the 1099-S at the time of sale, so you're not going to get it in January with your other statements. So just be aware to go through your tax or your closing documents and pull it out if you do see it there. At this point, I think the other accountants in the office too whether you get the 1099-S, whether it's issued or not, if we know you've sold your house, we'll usually report that on the tax return to prevent an issue at a later date with the IRS sending you a notice saying, you know what, the lawyer's office issued a 1099-S, you didn't report this sale of your house on your tax return, we're going to assess your taxes. So, and most of the time, you're going to meet the exclusion of not having to pay taxes on your house. Estimated tax payments, I do have this every year as well, where I sit with the client and they'll tell me, I paid exactly as you set up. Well, lo and behold, they missed a payment, or maybe they paid a different amount one quarter. They'll get an IRS notice letting them know that their payments don't agree with the what was reported on their tax return. And the final thing, make sure you're reporting the current year tax documents. I often have clients that I'm sitting with them doing their 2019 tax return. Well, they'll give me their 1098 for mortgage interest from 2018. So if you don't look closely and you're reporting the wrong amount, you will get a letter from the IRS stating the discrepancy. So just be aware that you're holding the right papers and reporting it properly on the tax return. All right, I just want to finish up with one last slide and talking about IRS audit red flags. So whether there are red flags or not, I don't know, but these items below may put you a little bit at a higher risk of being audited by the IRS, which typically is not an overall pleasant experience, and there's a lot of work involved from the tax preparer's point of compiling information that the IRS is looking for. So again, underreporting your income, if your collections on your Schedule C, your self-employment schedule, is less than the total of all the 1099s, and it's happened for a year or two, you may get a letter from the IRS looking to audit your Schedule C on your tax return. And once there, they're going to look at other items as well. So you'd rather prevent this. Another issue with Schedule Cs, if you're reporting 3 years of losses in a row, and maybe it's a small little side business that really is meaningless, the IRS will question whether it's a business or a hobby. So again, you don't want the IRS to bring this up. You don't want them to go there. You'd rather them not look at your Schedule C at all. So if you are in a situation with 3 years of losses in a row, talk to your tax preparer. You may want to show a small amount of income. Maybe don't deduct all of your expenses. I would stay away from being overly aggressive with reporting automobiles, especially if you're thinking of taking a 100% business use deduction on the auto. It will catch the eyes of the IRS. Same thing with travel and mail expenses. I probably would hesitate to be over aggressive. I mean, if it is, it is. I definitely will claim what your expenses are, but just be aware that significant expenses sometimes will show up on the IRS's radar. Another one, I do have clients that will sit with me and just tell me travel is $1,000 for meals. This year it's $2,000. My advertising costs were $2,000. If everything is rounded in zeros, it's a little bit of radar for the IRS. So I would be hesitant to do it. I usually will change the numbers anyways. If you're telling me numbers like this, I'll try to make it so it's not 2,000, 1,000, and so forth. But aggregate what the true expenses are, and that's what you should be reporting on your tax return. Charity deductions, large significant deductions will be looked at periodically. So I'm not saying don't claim them, but just make sure you have the backup of what makes up that number on the tax return. Same thing with non-cash charitable donations. I recommend keeping a list of what you donate, and you may want to take pictures and attach it to the list before you just lay it out on the floor. Take a picture of on your phone of what you're donating. That way, in case it's ever questioned down the road, you have backup of what you donated. The new thing that's on the IRS's radar are cryptocurrency transactions. So there was a checkbox on last year's tax return for the first year asking if you held or you bought or sold any cryptocurrency. That's actually going to be on page 1 of the tax return in 2020. So it's going to be reported as either yes or no on everyone's return. The issue is a lot of people they have cryptocurrency and then they're using it to purchase something either online or where it can be used. Once you're doing that, that's actually a sale transaction. So what you're buying, the fair market value of that item is actually sale proceeds of the cryptocurrency. So IRS wants this reported on your tax return going forward if you're not, it's just be aware it is the new item that's IRS is focusing on with regards to audits going forward. And the other item too, I just want to be aware of it. It doesn't really spark an audit. However, if you have foreign investments, make sure you're reporting them. There's a form called FBAR, which requires reporting if it's in excess, it's in value of $10,000 or more. The other big item are foreign gifts received. So if you have parents or relatives that live out of the country that gift you money annually, or your kids, and if the total amount received from that outside foreign non-resident alien is in excess of $100,000 in a year, you need to report this. The penalties are very significant for not reporting. So I do want to make yourself aware of it. If you have these items, make sure you let your tax preparer know. You don't want to be stuck in a situation where you're subject to such a significant payment penalty for not reporting these items. So that's what I have. If you do have questions, like I say, feel free to give me a call or talk to whoever you work with in the office for as your tax preparer. We can definitely go through any of your questions in more detail or give you a little bit more information if you're looking for it, or if you have a specific situation you want to talk about. Thank you again for joining us today. And we will be starting to make our tax appointments. So if you want to beat us to the punch, certainly give our office a call and we can get you on our schedule for this winter. And thank you again. Bye-bye.